Hello, I'm Dr. Renée Friedman, Global Head of Research here at EXANTE, and welcome to today's webinar where we'll be exploring opportunities and threats in the global economy. Today, I am very pleased to be joined by Dr. Sree Kochugovindan, who is Senior Research Economist at Aberdeen Investments. Thank you for joining me today, Sree.
Thanks for having me.
Absolute pleasure. Right. Well, it's a really interesting time yet again in markets. It always is. But it's been particularly interesting since the 28th of February. The world's changed a lot since then. Just to set the scene a little bit before we get further into our discussion, we know that the energy shock has hit consumer and business confidence. We're seeing a slowdown in the ever important U.S. services sector, rising cost input pressures. U.S. job gains remain low, but employment has still remained relatively okay at the 4.3 to 4.4% range. Despite the ceasefire, and we know that there's a memorandum of understanding that has been put forward to the Iranians that we'll have yet to hear back from, the Strait of Hormuz is still pretty much effectively closed. Oil has been fluctuating as a result. Energy prices, of course, are significantly up. Inflation expectations have risen. Central banks, once expected to cut rates, are either, as in the case of Australia, raising them or are having discussions about when rates may need to rise. Yet, despite all of this, we do see equity markets continuing to rise, continuing to improve. The S&P had its best month in April since 2020. And of course, the S&P 500 and the NASDAQ hit all-time record highs. People are still betting on that AI capex to sustain earnings and keep markets moving. And in fact, the market appears to be primed for broader gains triggered by even the slightest of positive news. The other side of this, of course, has been bond market performance, which has been mixed, with yields rising as inflation concerns, fueled by both surging energy prices, and of course, from geopolitical risk, along with growing fiscal sustainability concerns, has led to that repricing of central bank policy. So, at the end of the day, it's very clear that investors need to look beyond these headline geopolitical developments, these little bits of news that are coming out, as these geopolitical risks that are really hitting the market are not just being shaped by that government policy, but also by business strategies, by global financial markets. We've seen how Trump has responded to that, and even more in terms of public policy, national economic decision making. So let's start off with the questions that I have for you. The first is, of course, that we've seen the first order effects already. How do you think investors should be thinking about those second order market impacts of these shocks?
Yes, I think so far, as you've outlined, it's really markets are moving in tandem with headlines in a sense. This morning, bond markets have rallied because we've seen what is interpreted as progress within the Middle Eastern discourse and the conflict. So that's part of the story. But I think if we think in terms of second order effects, then you need to think about the impact on the economy and specifically the impact on inflation. Now, what we're seeing so far is going to be an inflationary hit. But how does this materialize? So right now, it's looking like headline inflation picking up over the course of the next couple of months because of the energy shock. And that will vary across countries depending on government subsidies and so on. Then we have the risk, and this is still a question mark, what happens to core inflation, core goods prices? If this we have some sort of resolution, it still takes time to reopen the Strait of Hormuz. It still takes time then to see what happens to other goods, others, for example, naphtha or gasoline prices, energy prices, other goods as well that go through that passage. It's not just an oil story, helium, etc. So what happens there? How does that filter through into costs through into the core goods prices? And then we have to think about really the big story is inflation expectations. So yes, we can think about urea, fertilizer prices, food prices will be next year that we really see the hit. But that second order impact and how that materializes in terms of growth and inflation and sticky inflation, persistent inflation, that really comes through inflation expectations. I can't really put a timeline on that. Whereas core goods, you can say, okay, that can come in the next 6 months or so. Fertilizer prices, food prices, that's in the next year. Inflation expectations, that's this underlying threat that central bankers are really focusing on. And they keep talking about it, and that's something that they will respond to in a more aggressive manner. So I think that's the key second round impact that investors, particularly bond investors, will be focusing on.
Okay, but what about, how do you feel that this will be affecting trading patterns? Because it's not just about the Strait of Hormuz being closed. It's also, we still have the tariff situation going on.
Yes, absolutely.
Which everyone seems to have forgotten about, the fact that the deal with China expires in June.
Yeah.
So, and we've obviously had, over the weekend or Friday, President Trump coming back with 25% tariffs in the automobile sector against the Europeans.
Yes, I think that's been a reminder. I think investors have forgotten about tariffs. That story that tariffs are, even though they started off very high last year, this time last year, we were talking at an event, at one of your events. And that was the main focus. And then we've had a reminder this weekend. Tariffs went from 2%, even though they're not as high as last year, they're still around 15%. And that is quite a meaningful shift. But also, as you highlight with China, again, that deadline is very important. And there's like an interaction between the Middle East conflict and the relationship between China and the US. This does have an impact on that relationship and on that deadline. So it's really a reminder that geopolitics affects supply chains. Supply chains also impact geopolitics as well. That weapon that the US administration hadn't really been thinking about this time last year. They didn't really account for China's power in terms of weaponizing critical minerals in a sense. So this is a big investment theme, I do believe, for equities and fixed income, because we have to think about this long-term structural story in terms of who owns the critical minerals, who has access to that. Friendshoring, it's not deglobalization, it's reshoring, rerouting, and friendshoring. That is the theme that we need to be thinking about, and that has very big implications for different markets.
We've already seen that obviously happening in terms of AI access, in terms of the access to chips, the impositions that were put on China, the restrictions. And AI is, of course, booming. We see it's the biggest growing sector. There's a huge level of capex involved within that. But there are some structural headwinds there, as you've noted. And just thinking about this point on the inflation, do you think that we'll actually see the type of cost push inflation that we saw during and immediately after the COVID pandemic? Or has the world's ability to respond to these types of shocks changed since then? Do central banks actually have that ability to respond to it now? Or debt levels just way too high and bond markets just far less forgiving?
Yeah, I think that there's a lot to unpack in that question, actually. So we start with central banks. What can they actually do? Central banks are very good at dealing with the demand side of the economy and tackling inflation by raising interest rates to cool off demand. We're not in that situation at the moment. It's really a supply shock, which makes it a lot harder for central banks to manage the economy this way. So the politics is the main policy driver here of inflation, unfortunately. We do have a number of scenarios that we're looking at. And if we do, as a result of this politics, see a big increase in, say, inflation expectations, which can then filter into wage expectations, that's something that central banks will act very quickly and start to hike rates more aggressively. But then what happens with that? That will then increase the recessionary risks and the stagflationary extreme outcomes that some of these scenarios, not just ourselves, but the Bank of England and other institutions are looking at. That's it's a tail risk, but it's a risk. It's quite meaningful. So that's something that they can sort of lean into. But near term, it's really a case of, if we think about the central banks, they're not able to tackle an oil price shock. This is something that traditionally food and fuel prices, they would tend to look through as a temporary increase in headline inflation. And what they really worry about is core. So as I said, the longer this strait remains closed, the more chance of core goods prices picking up. But then there are other sort of implications here as well. There are the political side, the fiscal policy side as well. And this does put a lot of strain, as you say, in terms of debt dynamics. And that's something that was a big story last year for bond markets. We did see a real beta between, excuse me, the more fragile economies that were seen as Japan, very high debt dynamics there. The UK was looking more vulnerable, and also France. US Treasuries would sometimes also join that party. And you could see this sort of divergence where yields would really spike in those economies. It would be a story in one economy that would then trigger off a sell-off across those three or four. So I think that's still there in the background. As you say, tariffs are still there, fiscal concerns are still there. And if anything, I would say we could see that returning in the second half of this year. Right now, everyone's focused on the headline risk around the war and the Strait of Hormuz. But I think we now need to see how do governments respond to this? Are there going to be subsidies, ways of smoothing this through for investors, for consumers and households? And how does that then impact debt dynamics? And how does the bond market deal with that? So I think that sensitivity is still in there and weighing on the long end of bond markets, particularly in the UK. At the moment, we have local elections today. There is a lot of focus on the government, potential leadership change, and that is all something that will keep yields elevated in the UK. So it really is a case of looking at specific pockets of opportunity. Yields are very high. They will come down as conflict resolves it starts to fade in the Middle East. But there'll be some countries that are more vulnerable than others. And it's really picking out those opportunities across the curve and across equity markets as well.
Just moving quickly on to equity markets, I'll get back to bond markets in a moment. There's so much of what I said. We've seen this outperformance by U.S. markets this year. Between April, it's the best performing month, as I said, since 2020. Hitting new highs, etc. Everyone is again focused on AI saving the world in so many ways. But I think markets are also really starting to focus on how AI will change business models, and they're now searching for that ROI on that high levels of capex. Do you think it is actually possible, given issues within for example, U.S. economy is K-shaped. We have a little less so in Europe, but there are still some issues. Do you think that AI can continue to raise all boats? And if not, and which part, really?
Yes, I think in terms of, it takes a long time for these AI-related productivity gains to really filter through into the economy. And into inflation, for example. So the new Fed chair, Kevin Warsh, is sounding dovish at the moment. He is referring to productivity as one of the themes. I agree, that is a theme. And historically, any sort of technological progress has been disinflationary. But we're in a very different world now in terms of those structural drivers of technology. Geopolitics is now an additional driver. Where deglobalization is not necessarily going to lead to trade growth slowing dramatically. We still have those pockets of global value chain concentrated in Asia, for example. So the next leg of this AI story interacts with the politics and with these trade routes as well. So we can see that so far it was Mag 7 in equities that were really driving the US equities and the global stock market as well. But now it's a case of what happens next. Where is, as you say, where do the returns come from? In our firm, our analysts are looking at builders versus buyers is a way of thinking about it, or the halo trade, hard assets. That's really the next leg of the trade. And who is the best positioned to benefit from that? Because AI is now affecting manufacturing. There's a lot of automation going on in countries like Korea and Japan. AI is going to filter into healthcare. There's a lot of investment in these countries. The new Prime Minister of Japan is really focused on strategic government investment. And the plan there is, okay, we have to worry about debt dynamics, but we need to spend where there is growth. Can we grow out of that debt to GDP problem that we have? And it's really looking out for which countries are doing that and what is the next leg of this AI trade. And it really looks at building out the infrastructure behind AI. And that still involves semiconductors and chips. It still involves investment in battery, in power, actually, not just data centers, but it's really looking at
energy infrastructure.
Exactly.
Yeah.
The grids, transformers, really, that is something that governments cannot avoid, unfortunately, and it needs to have a greater focus. So it's really looking at which companies are involved and focused on that, picking out a basket that is really connected to the raw materials and the build out and the infrastructure. So it's the hard asset side of the AI story that's going to really dominate, I'd say, for a good few years now.
Yeah, it's the buy the shovels, not
Yes.
just those were used in terms of, building going back to the gold rush. So it's buy the shovels. That was the person who made the money. We know that for certain.
Exactly.
Not everyone struck gold, but everyone bought a shovel. That's a good. So then that also opens up the idea of the spreading beyond, the growth spreading beyond just the US market. So when we look at European markets, overall Q1 numbers are coming through pretty strongly. There's been a very good level of performance, obviously not as high as in the US, but also globally, there's some interesting things happening, particularly, in Hong Kong, where China is basically using Hong Kong again as a launching pad as part of their Greater Bay Area initiative. We're seeing a lot of M&A and IPOs. And again, you mentioned Korea. There's been massive growth in the equity market there based off of those AI stocks that you in particular. So it is quite interesting that focus it's not just been a temporary phenomenon. It is spreading beyond. Thinking about this further, and that whole point about energy, it's about one that obviously brings us to the question of energy security. The events obviously happening in the Gulf States, happening the war there, as well as the ongoing war in Ukraine. It really highlighted the issue around energy vulnerability and the importance of energy stability, as well as the development of the energy infrastructure. So do you actually see this as potentially showing opportunities for renewables or not? I mean, renewables have been pushed quite a lot in Europe. Obviously, it's regulated where certain countries have to be by a certain timeline to be net zero. The US hasn't done that. Quite a number of other countries have not done that. And in fact, we think back a couple of years ago, everyone started to walk out of that ESG renewable story. Do you actually think this is the case that may actually push it, given what we're seeing?
Yes, I think there is. I don't think the renewable story ever really went away. It depends on who's looking at it. So the US, obviously, there's a bit of a pause there, given the current administration. But look at China, look across Asia. They're still investing quite heavily in green technology and renewable energy. So the last couple of years, that scale of investment has, I think it's quadrupled. So there you still see, it depends on who you're looking at. Europe obviously has been trying to increase their renewable investment. It's politically, it's slightly slower. There are regulations in place. So it really looks at it depends on where you are looking. And I think, that's a really important move. If we look at China, they were so dominated by coal as a main source of energy. So to shift away from that will be quite important when it comes to the climate dynamics as well. But also, I think this is something that is part of the broader geopolitical story. As you say, we had the shock from Russia, Ukraine. That was a big hit to Europe in terms of where do we source our energy from? If we are a net energy importer, this becomes a political story as well as just supply chains again. So for Europe, it was a case of the Nord Stream gas pipeline. That was the key focal point. But then what happened with Russia, Ukraine is that a lot of Russian supply was still getting through other routes, but it wasn't a big supply constraint. This is slightly different. And I think this really focused on top of what we experienced before during the pandemic, during the Russia-Ukraine war. This sort of heightens that risk. So it's really a case of this takes time, unfortunately, and some of the countries will still be vulnerable for a number of years. You can't suddenly turn on the renewables tap. So I think it will focus minds on the investment implications there, whether it's private or public. And then really it's a case of who are your friends? Who are your exporter friends? And India is a very interesting case there, where it's sort of treading a fine line between, Russia, US, the Middle East. They're trying to really hedge in terms of allies there. And I think that's a dynamic that you'll see more broadly across different countries. But also, before I forget, we were talking a little bit earlier about earnings. And I think when we're looking at these different the opportunities set that we look at now, I think earnings, but also valuations are going to be a key component of that. So Q1 earnings were very good, but it's not really hit by the current conflict just yet. I think Q2, you'll start to see a bit of an impact, and you'll start to see, well, whose earnings have been downgraded and from last quarter. Markets might still look through that, but it's what happens in Q3 earnings that will really determine the trajectory over the next 6 to 12 months, I think. So that's just something to bear in mind. Keep an eye on those earnings, any leading indicators there. And then another key, when we're thinking about the AI trend, which is a longer term 5 to 10 year trend, valuations today do determine returns over the next decade or so. So annualized average returns can be impacted. It's a negative relationship there. So it's better to really be looking at the AI story across EM, perhaps, where valuations have been hit and we're lagging behind and have been hit further. I think those opportunities will be quite golden and provide not just a tactical view, but also long-term returns as well. So that's something to note.
That takes me to my next question of the fact that many companies in the energy sector, the AI sector, the retail sector, financial services, agriculture and food packaging, because we know that they're going to be hit, are all facing various degrees of that operational ambiguity, essentially. Yeah. So it brings us to the point, what do investors really need to consider now, given that potential longer term instability? This instability doesn't just drift away. It becomes more reactive. We've seen this, how quickly we see bond yields up, bond yields down, dollar strengthening, dollar weakening, oil up, oil down. It's just instantaneous in a way that perhaps it wasn't, 10 years ago. Every little bit of news coming through. And this is going to perhaps become even more unstable over time. So how do you think investors need to think about that?
I think exactly as you say, 10 years ago, we didn't have to worry about geopolitics at all. So having a good geopolitical framework is really important. So in our team, we have a fantastic political economist, Lizzie Galbraith, who guides us through with her frameworks in terms of all the different political scenarios we've faced over just a couple of years. So right now it's the Middle East. Last year, as you say, it was US politics, shifting from, and what is the global order now? What is happening to NATO? What is happening to the UN? All of those moving parts there, they have huge impact on investment implications. And as you say, that geopolitical volatility is translating into bond market volatility specifically, because the bond markets are thinking about front end, central banks, what is going to happen to rates, policy rates, long end, what's happening to the debt to GDP ratio. And again, that links in the volatility of inflation. Unfortunately, we're in a much more insecure situation in terms of the cyclical side of inflation. So the cyclical, you can think in terms of, okay, the output gap, fine, but also commodity prices, different commodity prices. And then on top of that, the structural backdrop is also very, it also generates volatility. So if you think about the geopolitics and the impact on globalization for 20 years was disinflationary. It brought us a global labor market. That's not necessarily the case right now. AI, that was disinflationary, but that's over the long term. In the near term, AI could actually be inflationary because we have higher energy demands, and that's what we're facing over the next couple of years. And then there's demographics. Demographics now with an aging population, that is seen, it's a bit vague. Some people say it's inflationary because it reduces the workforce, and wages can go up in a very simplistic manner. But then it depends on immigration. Okay, immigration has changed in the US. So perhaps there they need to be thinking about their inflation in a slightly different way. But also it interacts with technology. So this backdrop has completely changed. Those broad headwinds and tailwinds for the central bank, it's more challenging right now. So I think we need to be thinking in terms of frameworks, both politics, both long-term structural drivers and cyclical. So you need like a patchwork of models to be looked, and you need to consider all of them alongside valuations and so on.
Excellent points. I mean, the point as well, mentioned demography, but it is that question whether or not AI will be used to replace some of those demographic challenges in terms of the ideas. Obviously, over time, it would improve productivity levels, but not just in the developed markets, but also in the emerging markets.
Yeah.
And in that way, she talked about globalization or deglobalization. In fact, AI allows a more globalized world.
Yes.
So thinking a bit further, my wonderful list of questions. In terms, going back to the point about bond markets that you just made, okay, equities, we know need to consider these issues around valuation, both now and the future implications of that. But the bond markets have been exceptionally volatile. They're nowhere where one thought they would be a year ago. So in terms of duration, not interest rate risk, etc., is it time, now that we're looking at things potentially stabilizing, for investors to think about extending their duration? We've seen a lot of investors be in the short end, very short end. We're looking at some, in real terms, some very good levels of returns now.
Yes, I think that's right. If we thinking about the front end, for example, there's probably a little bit too much priced in the way of central bank hikes, particularly for UK and Europe. Well, UK, not so much Europe. For UK, I think it's going to be very difficult for some of these central banks to be hiking at this point. I think central banks really need evidence from wages, from input costs, and really and inflation expectations, most importantly, and they need to balance that with the growth outlook as well. So if I take the example of Bank of Japan, who is in a hiking cycle, very slow one, I've been asked, well, does this mean that they're going to hike more aggressively? Probably not, because consumer spending has already started to roll over. It's slowing quite dramatically. Consumer confidence has really taken quite a sharp decline in Japan, and it's not just a Japan story. It's a case of how do households respond to this. That may delay a lot of central bank hikes. It may mean that, I mean, in the case of the US, it's an extended hold for the US and for the Bank of England. So there's a clear opportunity there in the front end. And then potentially a steepener curves are something that our rates PMs are still very confident about. Definitely for the next 6 months or so, possibly beyond, because beyond that, you still have the fiscal story. That fiscal dynamic is something that I think will stay with us for a couple of years. We might get some sort of relief from a policy that hasn't been implemented. There is a lot of fear, for example, in Japan, whether there's a consumption tax and how expensive that will be. In the UK, what if the government post this election? What if they turn more left? What does that mean for fiscal dynamics? I think those headlines will come and go, but it does keep pressure on that long end, and it does keep that concern, that fiscal fear on long end. So steeper curves could be a story for some time to come. Yes, they were a good trade for the last year or so, but I think it's still a trade that our PMs are still supporting.
It's an excellent point on there. Thinking a bit further, we've talked so much about this being a geopolitical story and looking beyond this, but at the end of the day, what geopolitical triggers need to change or are likely, in your view, to change how and where investors turn? Is it going to be just the ending of the war with Iran? Is it going to be, and obviously in the US, it's coming up to midterm elections. So that's another fear factor to think about.
Yeah.
And we also have, again, situations in Europe, which degrees of instability in terms of domestic politics. So what are some of those geopolitical triggers that you think are really going to move things looking forward?
Yeah. I think the triggers, I mean, as you say, the midterms are quite a big one for the markets, and no one's looking at that at the moment. So it'll become more of a concern as we move into the summer. But ahead of all of that, in the background, you have this need for extra defense spending. Again, that comes back to the bond market and debt dynamics, but also how is that affecting the relationship between different countries? Within Europe, for example, there are some countries who are already in excess of, the requirements, but there are some countries who are very reluctant to increase spending, and then that leads to, say, some of the southern European countries versus, say, Poland and Germany and so on. So that is some internal conflict there. I'm not sure if that's a big, if it's an immediate market impact. But it's just something that those political tensions can then affect elections and domestic politics as well. So it's just something to keep an eye on. That sort of anti-European sentiment has possibly subsided as a result of what's happening in the Middle East and with the US and so on. So I think some of that may have subsided, but it's something to keep an eye on. Who is then going next? Who's going to challenge the European membership next? That was a constant question. I think it might not be an immediate market driver, but just something to consider. And then across Asia, the relationship with China, the relationship with US, and the relationship with both. It's a fine balance that everyone has to walk. And I think that could be the source of periodic bouts of market impact as well. So everyone seems to have forgotten, actually, but just earlier this year, and this was specifically between Japan and China, but there are restrictions now because of some comments made with regards to Taiwan by Prime Minister Takaichi. There are now restrictions on inbound tourism from China, but also critical minerals exports as well. So not really an immediate growth impact. There are buffers in place. Japan has had these tensions in the past. They've built up their inventories. But how long can those inventories really avoid some actual production impact. And then what does that mean for the global value chain? These are all questions that periodically will re-emerge. And that's something that unfortunately, even though it's just it, even if we look at just local politics, now has more of a global spillover. And I think that's a theme. Those are the things that we need to be keeping an eye on. Even though they may seem just domestic or just between two economies, it can have a spillover. And that's what we need to be watching. So I wouldn't be able to name all the triggers, but these are just some of the examples. And that's a sort of framework we need to have in place when we read the news in the mornings. You know, what does that actually mean for supply chains, for politics, for inflation? Does it have an impact or spillover? And getting ahead
and
of
of
it, we
course,
can.
absolutely. And the big one, of course, you mentioned China and the US, but it's obviously around Taiwan. And it's also that wider relationship within ASEAN. And when we think about, again, if we're talking about AI chips in particular, or other parts of that chain, again, supply chains can very quickly be affected. People, again, they get very focused on the headline about the war with Iran and kind of forget these things are still drifting in the background and they are quite important. They haven't gone away. We've seen increase of military exercises by China in the South China Seas. The very explicit statements from President Xi against the Taiwanese leadership. So in fact, I personally feel that during this entire exercise, this war with Iran, China's been sitting back and learning quite a bit about how the U.S. may or may not act in the future if it were to take action. So when we think about geopolitical triggers, we also have to keep that in mind. It's not as much as what some of the bigger countries do, it's also what they're not doing. And the reasons behind that. So moving ahead, given this level of persistent uncertainty, because, welcome back to volatility. It's interesting you said geopolitics weren't as important 10 years ago. Well, if you were working in emerging markets, they've always been important.
Yes,
since the rest of the world has caught on in many ways. So given this persistent uncertainty, what do you feel this all means for portfolio positioning in terms of various asset classes, various regions, various countries? We've been very focused on developed markets, but obviously interesting things are happening in emerging markets and sector level exposures as well. That when you talk about that wider mapping that investors need to do.
Yes. I think so. Thinking in terms of emerging markets for a start, I think there are a lot of interesting opportunities there. Again, linked in with this AI story. So, who are the suppliers of basic resources? So that could be Latin America, as parts of Africa, but also outside of the US, Canada and it's not EM, but Canada and Australia also have natural resources as well. So thinking in terms of how these allies and relationships are shifting and who could be the beneficiary of that. So that would be one aspect of it. There's also, who are the manufacturers? We're going through a phase where manufacturing is in a way being digitalized. So or you could say it another way, AI is becoming industrial now. Who are the manufacturers? That's across different parts of Asia. So they could be the next beneficiaries as well. So North Asia may be an immediate beneficiary. Over the next 6 months, I think markets will still be focused on who are the net importers versus exporters. Countries like equity markets such as India may remain a laggard for a little while, but it could be the case that once you see a headline shift, some of these laggards have a bit of a spike higher, and then we get to settle into these longer term stories such as the manufacturers, the suppliers, who are the future mineral beneficiaries, who are the winners and losers in that story. In terms of sectors, we have a bias towards our PMs have a bias towards the builders, not the buyers. So underweighting consumers at this point, because we have a number of headwinds this year for consumers. Well, partly inflation, partly the uncertainties around the job market for different demographics that are hit in different ways, different skill sectors, and that's still evolving. So it's a case of really sort of positioning for that in terms of sectors as well. So creating baskets necessary that are more exposed to the critical minerals story, future minerals story, exposed to the EM industrials, for example. So really sort of selecting by region, by sector. And is very much skewed towards this AI story for now. But I think that's going to be the dominant theme. It's still a focus for investors, but they're just look at all the capex that's been spent so far. How are we going to, who's going to monetize that? There's this fear in terms of software companies that in sectors that have been disrupted. Let's maybe take a pause, see how that pans out. But for now, we have some certainty in just a few sectors. So really picking out where the long-term story is stronger. So you'll have these bouts of volatility, but it's easier to sort of navigate through that if you have a long-term compass. And I think that's where some of these sectors really start to outperform potentially.
Very, yes. Just thinking at that point in terms that you just want to touch on, you mentioned the demographics and the reactions in different countries. Obviously, within the US, there's been a lot of talk around the K-shaped economy. And it's different in other parts of the world. Just the structure of the economy is very different. Europe is less K-shaped. The UK, debatable. And of course, Asia is also, I wouldn't say as K-shaped, but it's hard to say in terms of asset ownership. So how much influence do you think that will have in terms of other sectors that people should be looking at? Particularly when we look at US equities outside of that AI focus, is there something else that will be driving, other sectoral growth or that will contribute to that bond market worry because of that we are seeing, unfortunately, still that K-shaped economy?
Yeah, I mean, I guess just starting with the bond market concerns, which would be more fiscal, I think the risks of a K-shaped economy are political, unfortunately. And we've seen that in a sense, that's why we have the US administration that we have right now. Whereas, the support for that administration, obviously at the moment, the polls are very weak. But the sentiment there is quite similar across countries in that there are some groups of the economy who are not benefiting as much they're not exposed to equity wealth, for example. They might be some groups, and this is changing. It's not just by skill set, but this is changing and fluid as to who is impacted by AI, who is able to leverage it better, and which countries really invest in that skill set. And that's going to be to do it. So there are a lot of moving parts there. But I think for now, it's a case of, well, how does this then impact the fiscal trajectory across these countries? And I think I'm still quite comfortable with thinking, well, where are the debt to GDP levels already very elevated? And that will distinguish which bond markets are more vulnerable in that sense. But in terms of broader equity sectors, not so much from a K-shaped story, but I wonder if this demographic story again is with an aging population. I'm just thinking again about Korea and Japan in terms of how they are tackling their labor shortage and the need to care for the elderly and digitizing or more robotics and more sort of hardware, intelligent hardware in a sense. And they're really investing in that, not just in manufacturing, but also in healthcare. So that's another sector to think about, whereas it might just be Asia today, but does that translate into other markets as well in the future? Who's going to follow on and who's going to follow on first? Because I'd say it does seem to me that they are the leaders there. But who could be next? Cybersecurity, huge one as well.
Yeah, absolutely
Yeah.
massive. So it's really, again, goes back to thinking beyond. There's AI, but then it's how AI itself is implemented in manufacturing, how
Yeah.
it's implemented in defense, how it's implemented in caring in that demographic issue in terms of caring for an elderly population, in pharmaceuticals, how it's used.
Yes.
So it's really much broader than just, hey, let's invest in chips. There's
Yeah,
so many opportunities out
absolutely.
there.
Absolutely. And that's the second round effect that we're starting that journey now. The spillovers into different industries and how quickly different sectors are incorporating this and evolving. And there are a number of question marks there, but these are the obvious ones at the moment that we can start with. But it's really a case of a fascinating time to be watching this technology develop.
It is. Right. I just want to check if we have any questions coming through. I don't think we have had any. So if you do have any questions, please do send them through now. But I will ask one more question. I'll be a bit cheeky here going ahead. One of the big things that we've noticed, obviously, is what's been happening with the dollar.
Yes.
And that question of, is dollar weakening? Is this still going to be seen as a long-term phenomenon? Is it being supported just temporarily by this petrodollar? Because obviously the U.S., it kept its commitment. What it said in 1974, they agreed with the Gulf states will come and defend you, and it has done that. And that's how we saw the dollar go up as a result of that over the past since the 28th of February. Yes, it's down for the month this month, and performance has been up and down. But it is quite an interesting point that we've had amongst economists, this discussion of, well, there'll be longer term dollar weakening, or there'll be or there won't be. What does the Trump administration want?
Yeah.
This.
Yeah.
What are your views on that?
Yeah, we discuss this a lot internally. So we turned bullish on the dollar about a month ago. But that was a geopolitical petro story very much. And primarily it was a case of, this is the hedge at the moment. Other safe havens, I mean, Swiss franc, the yen has its own issues. Gold, well, there was some gold selling because it had done so well for the last year or so.
Profit taking.
Yeah, and some profit taking, raising cash, margin calls and things. So there's some technicalities there with gold. Dollar was a cleaner way of hedging this particular crisis. But if we take a step back, and before this conflict, there were quite a few challenges to the dollar, and part of that story was the US administration. What did they want? And I use the example of some of the conflicting messaging that we've had from the US administration. If we think, I think it was in January where the yen was struggling, and then we had a rate check by, not intervention, but a rate check, which is like a signal from the Ministry of Finance of Japan, but also from the New York Fed. And that really threw traders. I mean, they were contacting clients and, saying, this is happening. This is very dollar negative. It's very bullish, the yen. They're going to intervene. There was some volatile moves in the currency markets. President Trump comes in and says, we want a weak dollar. It's good for our manufacturing. Makes sense. The very next day, her Treasury Secretary Bessent comes in and says, no, we want a strong dollar. And the market was thinking, okay, we sell, we buy, we sell. So this volatility, I think, is very interesting that 1 week, because I think ultimately what this administration would like is a stable move, steady, not too volatile, not too sharp, but a weaker dollar would be helpful for manufacturing in the near term. So I think that is one aspect, and it'll be interesting to see what the kind of signal we get next week when Treasury Secretary Bessent visits Japan. So that's one side of it. The second side of it, I think the political conflict that we're seeing, I mean, obviously the US is now blocking as well as Iran blocking. But prior to that, when some oil was getting out, you weren't paying for that in dollar. You were paying for that. I mean, I'm not a crypto expert at all, but tokens were used. Chinese yuan, Indian rupee. The dollar was not the currency at that point. So that's just something to be aware of as this conflict evolves, as Iran negotiates. It is likely to, negotiate a better term, perhaps, it seems, just from recent news overnight and over the next 48 hours, we'll see. But, maybe sanctions are lifted. What about assets being frozen? What are the benefits there for Iran? There is oil there that needs to, come onto the market. How is that paid for? So I think that's another side of the story there. But in contrast, if we were to try and think, those are bearish dollar signals. But then on the other side, if you think about, US equities are doing very well, aren't they? And that's a dollar bullish story.
Exactly.
But then if we are diversifying away from Mag 7, how long does that last? So I think this year will be very volatile for foreign exchange as well. And foreign exchange will not just be about trade flows and capital flows. It will be political speculation as well. And I think part of the story with gold last year was partly that US debasement story that we were talking about a year ago when tariffs were first hitting the markets. So that concern about US institutions, that was reflected partly in the gold rally as well. So gold was slightly political last year. So
probably still is, in the sense
yes,
that we've seen central banks, they did slow down their buying, but they've picked up again.
yeah.
So gold, it is, I know we have a question up here, but
Question
what do
on
you think of
gold,
the
yeah.
gold market?
Yeah.
Gold has been, since it did come down in February, it's been due to that margin call, essentially.
Yeah.
And profit taking.
Yeah.
It went up very, very, very quickly, very fast. I should say it went up kind of there very quickly. Central banks are still buying it.
Yeah.
And we are now, other countries, as you mentioned, are looking at repricing some of their trade. I mean, in another currency. We have the BRICS, obviously, for many years talking about developing a secondary currency, or the point, of course, being that the dollar is the most liquid, and most trade payments are made in dollar, and commodities are still priced in dollars. So the dollar won't be going away anytime soon. But it's still going to be an interesting relationship with the gold market, whether or not the traditional ideas around that will be to hold, or if that's actually now completely changed because of what we're seeing in central bank purchasing gold in central banks and others just moving out of US treasuries.
Mm-hmm. Yeah, I think because the gold story became a little bit volatile. I think that as you say, the central bank purchases are still a structural support for gold. But what we've been talking to clients about is, okay, gold is one side of the story. Silver was sort of rode its coattails last year. It's an industrial metal. It doesn't have the same central bank buying the same structural support. Look at future minerals instead, critical minerals. That would be from commodity space. That would be another way of diversifying your portfolio. And it's a structural long-term story as well. So having exposure to future minerals in some form, whether it's via equity markets, via miners, that would be definitely a thing to look at. We're also looking as another sort of portfolio position would be infrastructure itself, infrastructure investment as well, having exposure to its private markets, but there are some long-term structural support there. So having exposure to that would be quite good in this AI environment as part of that AI story and like build out story as well.
Yeah, I mean, we do have a question from someone about whether or not we're in an AI bubble, essentially, and that the fact data centers do have a relatively short lifespan. I think they're quoting the IT equipment lasting 3 to 5 years, and this is a known fact. it's the fact that IT often it needs to be upgraded, yep, continually. I think the big issue, I mean, as being in an AI bubble, you mentioned valuations earlier. Do you feel that we're in a bubble, or do you think that we're actually pushing outwards? Because we've discussed so much of this webinar has been about that pushing out.
Yeah,
Is that in a
it's
bubble or
like
no?
there are pockets of bubbles, perhaps. Like if you want to think about a bubble, I don't think we're in a bubble yet. I think even where are the valuations really stretched? It would be in the US. It would be in Mag 7. There's there's a big question mark over some of the software companies. They've taken a hit already. If there was a bubble, then that's already partly priced. But then it's a case of that's a very narrow view of AI. You need to look beyond that. It's again, it's about the next leg of this story and who are the beneficiaries there. And these other indices are not are still quite cheap, historically and relative to the US. So it's a case of just diversifying. Our multi-asset portfolio managers are all about, multi-asset and diversifying. You can trade one story across assets and hedge that one theme. So it's a case of really broadening out your mindset there.
Right, and that brings us to, I think we'll call it the last question for today because we're running out of time. This point on U.S. debt rising significantly, which we discussed. Question whether or not it puts the shadow of the American and by extension the world economy. What are your views on that? And you talked debt dynamics a bit and the impact on bond markets. But does that actually, is that the potential that rising debt to, I suppose the question is, to slow the world's economy or not? The IMF this year did come out saying we would see a slight drop down in growth for this year and even into next year.
Yeah, I mean, bond yields are high, and that does have an implication in terms of translating into lending rates and the credit cycle. It does have a macro impact. But I would say when you talk about debt, I think that question is very specifically government debt. So I just flag that, if we were to compare today with 2007, much cleaner position because private sector debt has deleveraged over the last decade or so. I mean, we're in a much better position in terms of balance sheets of corporates, whether it's non-financials, across the board. Those corporates that had been really vulnerable 2007 are in a much stronger position now. Households have deleveraged. They're in a much stronger position now. If anything, households are a bit more cautious at the moment. And you can see this across the different countries. Like savings buffer has been run down. But it'll be, and in some countries, like for example, in Asia, they're building it back up. So I think it's not really, we're in a different dynamic now. I think we've had the GFC. That was a different balance sheet story. Now we have a bit of a sentiment issue, I think. So I'd say the overall debt dynamics is stronger, but I think corporates and households have just gone through a lot in a short space of time, just 5 years, to have some big shifts in terms of the pandemic war to two wars now that have hit markets. So that would be my take. We're in a stronger position now, but I think it does have a macro impact, and obviously a portfolio impact as well.
Excellent. Right. Well, I think we are out of time for today's webinar, and I'd like to give you a huge thank you. It's incredibly interesting. It's great for people to hear that despite that geopolitical mess that we find ourselves in, and those headline worries, that there are a lot of risks out there, but there are still so many opportunities for them to look for. They're there, and without a doubt. So thank you again for joining me today, and to the audience, thank you for listening in. If you'd like to find out more about EXANTE and our global offerings from our platform, please go to exante.eu, where you can also find additional free market analysis. And we look forward to you joining us again in the future on future webinars. Thank you.